I'm Robert and welcome to my channel, where I discuss everything about automated algorithmic trading, or simply algo trading. If you've been watching my videos recently, then you've been following the process of my multi-position trading paradigm using Jackrabbit TV and Jackrabbit Relays conditional orders to create a rather unique and advanced approach for trading. I've been doing this using Australian dollar, US dollar as a means of demonstrating the technique. But I wanted to show just how this technique can be applied to the cryptocurrency market as well, and particularly Bitcoin. Now, Bitcoin's interesting history of having a 40% retracement on a regular basis when it does retrace makes it difficult to measure volatility. It also means that the market itself has a different dynamic and instability, comparatively speaking, to the Forex market. One of the biggest issues with the cryptocurrency market versus the Forex market is it's not cyclical in nature. For the most part, the cryptocurrency market functions much like the stock market, and that prices are expected to continually go up over the long term. So that means a different thinking process is necessary, and that trading needs to be handled slightly more cautiously. For the standpoint of trading Bitcoin, that means really long positions only are a long-term staple for trading. But when you're dealing with prices that are close to the all-time high, long positions are extremely difficult to deal with, particularly when you look at the 2021 year when Bitcoin entered a 1-year bearish trend downwards, where it lost over the course of that year 40% of its value. Those kind of markets are extremely difficult to weather, and it means that the trading approach, the paradigm, and the layers have to have a completely different construct in managing the appropriate risks and budget requirements. It also makes it more difficult when you have exchanges that require position sizes of $10 as a minimum. It's not the same way of being able to spread out your risks and being able to mitigate your budget consumption as the Forex market. It can lead to a rather difficult process all the way around. So this is where I want to start today, to look at a basic principle for either an aggressive or hyper-aggressive approach within the cryptocurrency market that can be used as a stepping stone or building block to begin to hone in and fine-tune different techniques. So let's get started with the chart at hand, which is Bitcoin on the 1 minute. Now I've already got a basic chart set up, so let's get straight to it and look at that chart. Okay, I'm going to be using Range Hunter and ATR. Now both of these are Jackrabbit TV indicators. We're going to be using Range Hunter in order to deal with the volatility of the entire history of a time frame. This gives me a perspective by which when we look at the market, we can calculate probabilities on a mean reversion technique. For cryptocurrencies, mean reversion is really a good way of helping decide whether you should go long or short on a position. For example, this middle line right here, or the median, this is basically a neutral point in this market. Anything below this point has a probability of going long. Anything above this point has a probability of going short. Probabilities are not guarantees. They are only the potential of an assessment that the market may hold, but that does not guarantee it's going to be the case. As we can see here, the market went down more. But the lower it goes, the higher the probability that it's going to rebound back to the median. So let's take a look at this market and see just how frequently positions play out. This is really an interesting approach to dealing with the market, as we can see when the market changes. For example, right here, it's consistently making lower lows within this particular time frame analysis. And that really is the point of view that this process takes. And that is a limited scope and scale of the market. So by looking at this in such a way, we begin to limit our thinking process to the possibility of what probabilities might occur. But as we can see, even at being at the lowest part of the range, the probability is still not strong enough for it to rebound as quickly as one might like. So the hyper-aggressiveness of this particular strategy has its inherent risks. Coupled that with the unusually large position sizes, and trading this asset can be quite difficult. So that's where we want to use a secondary indicator, and in this case I'm going to use ATR, average true range. And that is really going to be the pivotal point of how we find our entry points. So let's turn on the ATR, and we can see by the thicker lines here the upper and lower range. And I have the ATR set to 10 times the value of the closing price. And I'm also using a simple moving average smoothing to help create that band that we see on the chart. Now, even though Range Hunter is set up to show only buy signals, the ATR shows buy and sell signals. So as you can see, ATR signals a sell, even though Range Hunter signals a buy. This is not where we want to be. We want only to look at buy signals that match up both Range Hunter and ATR, as they are likely to have a higher probability of price rebound towards the median. So let's take a look at all of the positions, and you'll see that it's a very different approach, comparatively speaking. That is the Range Hunter buy indicators versus the ATR buy indicators. We can see a significant difference in that regard. So we have a filter that gives us a way of not burning through our budget as quickly. And that really is the point that you want to look at when dealing with Bitcoin. Because of the market's unstable and high volatile potential, you need to think about your limiting factors along with how to control or tune those limiting factors to still maintain the hyper-aggressive base layer. So we see in both cases we have two indicators. So two buy signals tell us where and when to purchase. And what that means is it'll give us a better opportunity to try to put statistics and probability in our favor. It will also mitigate the amount of risk we take by limiting the number of positions we purchase. And as we can see, we do begin to see just why I call this a hyper-aggressive layer. As we can see, the number of purchases that combine between the ATR and the range hunter strategies. So there is quite a bit of risk involved, perhaps more so with Bitcoin or cryptocurrencies in general than versus the Forex market. That really is one of the pivotal points of the multi-position trading paradigm. When examining risk and budget considerations, the difficulties of volatility begin to take a whole different dynamic, just because the market is not cyclical in nature. So for this particular case, I am looking for long positions only, even though short positions might be a consideration with very limited amounts. But realistically, a short position is going to have a much significant higher risk associated with it. Now we can see more of the hyper aggressiveness of the strategy as we see more of the ATR buy signals coupled with the range hunter buy signals. So if you're using, say, a 1 or 2% take profit, it's very quickly easy to see just how this could accumulate within the account and consume a large portion of your expenditures, of your budget itself. With this being only the base layer at a $10 position size, it's very apparent just how quickly this is going to burn through our budget. And so considerations and testing are absolutely critical. In fact, there may even need to be more controls on just how many positions we take, such as using the high-low algorithm or coupling an RSI or some other indicator just to cut down the number of entries. Even though this is supposed to be a hyper-aggressive approach, the realization is you still have to function within your budget, and that could be a problem for any kind of a strategy using Bitcoin as the asset. So as you can see, this is a clear situation that cannot be understated, and the level of risks involved in trading this approach are absolutely significant. When you're testing and analyzing, do not underestimate just how bad this can go very quickly. If it looks like too many signals, it probably is. Add another indicator and tone it down. There are a reasonable level of different approaches you can take. Experiment and test. Those are going to be the only ways that you are going to know what will truly fit your own personal risk assessment. If you like this video, please give it a thumbs up. If you're not subscribed, please take a few minutes to subscribe. Both help this channel grow and help get more information available to the public on how to deal with real-world trading situations. As we continue to look at the chart and examine it, we can clearly see a significant disconnect between range hunter and ATR in terms of the number of positions produced. That is important, where you can already see how I am trying to use statistics and probabilities to put me in a better position in relation to where the median is on the account, or I should say on the asset. So always take time to test. And when you think you've tested enough, go back and test it again. This is where things can go bad very quickly if you don't understand your risks. And if you put this in a market such as futures or options, your risks automatically go up drastically because now you've got the additional pressure that the asset has a natural decay rate. And that could cause problems in and of itself, far beyond what you anticipated just from trading the asset. If you have any questions, please feel free to let me know. If you want to support my work, please subscribe to my Patreon. Thank you for watching.